Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. This is Bobby Rains here for our once every 3 weeks members-only workshop. As always, put questions in the box whenever you have them. I have the question box in front of me. I'll either get to your question as you send it in, or we can, there's obviously always time for Q&A at the end of the session also. So let's talk about our agenda. We have a market update as usual, a little bit about what's going on in Investors Observer, member-driven content, questions, site demonstrations, etc. If you send in slides send in questions ahead of time, I can prepare slides and things like that to help answer questions that may need to be illustrated a little bit better. You also probably get a nominally more coherent answer to your question if I have time to think about it a little bit. But with that said, go ahead and throw questions in the box whenever you have them. All right, so let's look at the market update. As usual, here's our S&P 500 chart, 2 years of 1 year candles. We sort of broke out to a new high this week. You can see that sort of failed a couple of times here. And then did this. We crossed 3,000 on the S&P 500 earlier today, which is really mostly significant because it's a number with more zeros than other 4-digit numbers. But, it's never happened before. So you can all say, I remember when about that now. But yeah, I mean, technically we're pretty much at new highs. You would kind of expect this level where we topped out a couple times to be support on the way back down were that to happen. And we'll talk about why things might go back down in a few minutes. But yeah, that's pretty much what the market looks like. And I did this chart again. The time scale is slightly different than it was when we talked about this 3 weeks ago. But again, S&P 500 is the left axis and the red line. Yields on the 10-year Treasury note are right axis and blue line. And you can see that spread is pretty wide in terms of things going in opposite directions for much longer than normal. You can see every other time there's been a big divergence, like say here or, here, things tend to come back and cross each other again. So it's a little bit strange. What it essentially means is people are buying stocks at the same time they're putting a lot of money into bonds. It's maybe even stranger on the bond side because the federal deficit has expanded quite a bit over the last year or so. And so that means there's more supply of bonds on the market, and yet the price keeps going down, which means demand is going up, which tends to kind of mean that, people are happy to take a 2 or sub 2% return for potentially 10 years as opposed to any number of other choices they could make with money, which is not really a ringing endorsement about people's outlooks for growth. If you think 2% or less per year is a decent return over 2 years, that's it's not a particularly bullish sort of sentiment. All right, so next slide. So what else is going on? It's really been sort of the Fed show recently. The Fed and interest rates. The jobs report Friday was that initial sort of downward reaction was because a good jobs report is not good for rate cuts, although it is good for the economy. So that's kind of a weird thing going on there. Powell was on Capitol Hill today, Jay Powell, that is. His testimony really seems to be still pointing toward a rate cut, and you can see I cut this out of the webpage from the CME has a FedWatch tool. If you Google FedWatch, you can find it if you're interested. And so this chart is essentially the probabilities for interest rates after the next Fed meeting. And so, yeah, the current rate is this 25 to 250 range. You can see that a month ago, there was essentially the market was saying about a 19% chance that the Fed holds there. Well, that dropped to 0 after the last meeting. But then you can see here, this time last week, so Wednesday of last week, 29% had essentially a 50 basis point cut. And then that went, the 50 basis point odds went way down after the jobs report on Friday. And then after Powell talked today, they rose a little bit. People have been calling this 100 and, something like, I think I saw something earlier today where somebody called this a 112% chance of a rate cut, which is sort of weird. Just because how do you have something that's more than 100% likely to happen? What that actually means is they're essentially combining sort of these two numbers, right? So saying it's more than 100% chance, or if you add the probabilities together, it looks likely that the Fed will cut more than 25%. Is how the probabilities are priced in. But yeah, the Fed's not going to cut by they'll cut 25 or 50. They're not going to cut by 32 or whatever would be the midpoint there, 37. So yeah, it'll be one or the other. It will be interesting to see what happens. My guess is it's still very much up in the air in terms of the data. And yeah, we'll see what happens. That jobs report was pretty good, although Powell did make some valid points about how there's this big disconnect between what the sort of business community says about the labor market and what the data says about the labor market. And that the business community keeps saying, oh, we can't find workers, we can't find workers, it's so hard to find workers. And data about wages seems to say that wages aren't rising. So typically in a market, if you really want to buy something, you pay more for it. And there's no reason that should be different in the labor market. So what essentially I think Powell thinks the business community is saying is we can't find workers at prices we're willing to pay, which is a different problem than we can't find workers, period, full stop. And that's why we sort of see every month the economy creates jobs, the unemployment rate stays where it is, because people are essentially coming in off the sideline because even wages aren't rising fast, they're rising a little bit, and so those incremental increases bring in sort of an incremental number of participants to the labor market. And then these the last 3 bullets on the slide are basically the same from 3 weeks ago. Yeah, no one still knows anything about the trade picture. The headline yesterday was that some U.S. officials had spoken on the phone with some Chinese officials, but that was pretty much the extent of the report. Yeah, I don't know who hung up first or what they talked about, or when the next phone call or other talks will be. So it's really hard to. I mean, it's better that they're talking than not talking, but that's about all you can really take away from that. And then, yeah, some of the data is softening. This last week's jobs report was better than the previous one. But yeah, some of the other data still looks a little bit weak. But the economy is still growing overall, so it'll be sort of interesting to see what the next couple rounds of data look like. And then, yeah, the situation in England is they're still trying to figure out who the prime minister will be, and then I guess they'll go back to negotiating that whole business there. But yeah, I don't have anything new to say about that either. So that brings us to the end of the market update. Well, let's see here. There's a question from Frank about how do rate cuts affect bank stocks? That's a good question, Frank. Typically sort of the thinking is that lower rates are not as good for banks, just because banks tend to make money on, or have historically made money on the spread in interest rates, right? So the difference between, right? So if you have a deposit account, they're paying you interest for money they're borrowing from you, and then they are lending that money at a different term and a different interest rate, and typically they've made a lot of money off of those spreads, right? So they pay you 1% on a checking account if you're lucky, and then they can charge some other higher percentage rate on a mortgage or some other kind of loan. And so rate cuts are typically more on the shorter end, whereas the mortgage rates are more closely tied to the bond market than the overnight rates that the Fed is paying. But your shorter deposits and things like that are more closely tied to the prime rate or the Fed overnight rate. So they can be good. Yeah, higher rates can be good for banks on that end. The other side of that coin, though, is interest rates have been so low for so long that net interest income, which is that line item on a bank's earnings report, is less as a percentage than it was certainly some years ago. And so so if interest rates keep going down, you'll probably see a lot more refinancing and other activity like that. And in that case, banks won't make as much on those interest rate spreads, but they take some percentage or some fee with every new mortgage they write. So they end up making more money in fees in a lower interest rate environment, and then they probably fewer people are going to refinance if rates rise. But in that case, they make money on the credit spread. So really, like what we're talking about here, which is 25 points off the short end, it's really hard to have a strong opinion about bank stocks on either one of those. Really, I think a better way to trade bank stocks is, certainly, if you're trying to day trade bank stocks, those interest rate changes can probably be a good way to make money. But if you're looking for is this a buying opportunity or a selling opportunity, I think you're better off looking at, do I think the economy is going to grow over the next, some period of time, more or less than, I think that's a better way to judge bank stocks than just sort of some guess about what interest rates are going to be for, potentially the next 6 weeks before the Fed meets again. All right, and Jeff says, do I see the stock market as steady for the remainder of the year? And he put quotation marks around steady. I think I might see the market as steady with quotation marks around it for the rest of the year, but maybe not if you took the quotation marks off. And what I mean by that is, let's go back. Yeah, the market hasn't been particularly steady for the last 2 years. I don't know why I would expect that to change. It has been pretty much in a range, though. From here to here was not a particularly enjoyable period last year, certainly. But, typically the thing about stock charts is if you don't like it, you can zoom out and it looks a lot better. And that's where we are today, right? From here to here is ugly, but if you had zoomed out, you'd see that over the preceding 2 years, even on Christmas Eve when the market bottomed out, you're still up over the last 2 years. This has been a pretty bumpy ride, but we're still up quite a bit over the last 2 years. So, generally what I expect is more volatility just because so much of the stock market seems to be tied up in the political situation, which is, sort of a thing that's impossible to predict. So that's, really my sort of, if I had to make a prediction is things will be volatile, but the underlying economy is still pretty healthy, and I don't see a real reason to move away from having a bullish bias in that regard, but I don't think it's going to be steady or necessarily a smooth ride along the way. And thus I'm willing to endorse steady with quotes, but not steady without the quotes. All right, I don't really have much of an update about what's going on at Investors Observer. I think I've said before we're working on a big project we're very excited about, but I don't have a timeline as yet. Although, I guess, we're closer to having a timeline than we have been in previous conversations. So there is that. All right, so with that, let's move on to questions. We got a question from Darby this time through. And then, yeah, any other questions people have, feel free to put them in the box. Darby says you publish a put-call ratio every day. That's in the morning update. But she doesn't have context for it. If, for example, the 20-day moving average today is 0.65, is that high or low? Do we have a graph somewhere on the website where I can see historical comparisons? So this is a really good question. Thank you for that, Darby, if you're listening. Put-call ratio is essentially a measure of sentiment. The put-call ratio, I don't remember exactly how many. Yeah, CBOE is just making ratios and indices as fast as they can because they can make money licensing them and things like that. But yeah, we use the equity put-call ratio, which takes out things like index options and some other things. And in that, in that space, call activity is typically bullish, whereas more put activity is typically bearish. And I actually went and ran these numbers today because I didn't know the exact figures here. But yeah, so since November 1, 2006, which is as far back as the CBOE makes this particular series available, the ratio is 0.64. Last week when Darby asked this question, it was 0.65. Yesterday, the 20-day moving average was 0.65. Yesterday, the actual headline number was 0.58. That's from this morning's morning update. And the thing is, the 20-day moving average doesn't really move very much. So in terms of looking at the market sort of in the morning update and trying to see like, all right, where is the sentiment today, comparing yesterday or today to the 20-day moving average is probably a pretty good reference point. And we can look at this chart that I put together here. So this is that whole since November 2006 period I was just talking about. Every single day put call ratio. It's the exact same data series we have in the morning update. And so, yeah, you can see here it's sort of, it goes up and down. There are certainly some trends visible. But on any given day, I think a probably better thing to look at. But yeah, I mean, even with these trends, it's, the absolute lowest lows are, not too far from 0.5 and the highest highs are, less than 1.5. So the 20-day moving average at any given point may go up and down a little bit, but it's not really going to move very far. And so comparing, one day to the 20-day moving average is pretty good way to do it. And look at yesterday and look at today, and that'll give you an idea of sort of where market sentiment is, which is really the point of the put call ratio is kind of as a sentiment indicator. And really pretty much anything above about 2/3 is probably a pretty bearish sentiment, and much below that is going to be more bullish. All right. Yeah, so that is the extent of my prepared remarks. We can open things up to questions now. Any questions you have about the website, etc. Certainly here to answer them. All right, so Rick wants to know, can the put-call ratio be used as a contrarian indicator? I mean, probably, Rick, in the sense that, if you get a big move in one direction, right, like very strongly bullish day in the market, the put-call ratio will typically fall. And a lot of times, a big run is followed by a decline, or a big drop is typically followed by some kind of bounce. And so, yeah, the put-call ratio certainly in those cases could be used as a contrarian indicator. I mean, this is probably a little bit closer to, I would say, if you're trying to just trade based on the put-call ratio, it's probably a little closer to trading the VIX than maybe trading some other things in terms of this is much more, right, the VIX has a sort of average number, right? Like you can average you could take the average of the S&P 500 for the last, some number of years, but that's not really telling you anything. Whereas this seems to be more like a mean reverting series of data. And so, yeah, if there's a big diversion in either way, right? Like if the VIX goes way up, shorting the VIX is probably not the worst idea. And the same if it, hits a low. That's not financial advice. That trade can absolutely murder you because things can stay up and things can stay down. But yeah, certainly, my guess is if you put this up against a stock chart, a lot of these extreme highs or lows are possibly at least short-term inflection points, if not long-term inflection points. One thing I left out of the sort of market update is that earnings season does start sort of toward the end of next week. Some big banks come out and report. So we'll get some numbers there and also probably some economic commentary from some banker types. So that's typically pretty interesting. So yeah, we'll have that, and then the next 3 weeks after that will be pretty much all earnings all the time. And so the market probably will be a little more wiggly after that than it is right now. Right now, everybody's sort of paying a lot of attention to what Jay Powell was saying. But outside of that, there's not a lot to really push the market around. So Rick, what we're using is the equity put call ratio. So that's it's just calls and puts on stocks as opposed to the various indices and some of the other things that you can buy and sell options on. The total put call ratio includes some of the things that are backed out of the equity put call ratio. My guess is it probably correlates pretty closely with this. It does tend to be a little bit closer to 1 just because activity on the index side is a lot more activity on the index side is a lot more sort of institutional, and so people are doing different things there where they're having less of a directional bias. And so once you get into, gamma hedging or whatever sort of other strategies people are doing, there's a lot more the volume on the put and call side is a lot more balanced. So it probably is no more or less useful. Rick says he thinks it's about 0.95. That's probably about right. Yeah, it's usually closer to 1 than this one. It's probably, if I had to guess, I hadn't really compared the two, it's probably a little bit less wiggly. But I would guess that I would be surprised if one was higher than the mean for any real amount of time, while the other was lower than the mean. That would be certainly an interesting, that'd be an interesting phenomenon, but I don't think it happens very often. So Frank, I don't know exactly what you mean about, so Frank says fast didn't make it up to expectations. Would you recommend doing a covered call in that event? I don't know if fast had earnings today or something else is going on exactly. It's my guess based on the question. But most of the time. I wouldn't do a covered call immediately after an earnings report. I kind of would rather wait and see sort of what shakes out after the earnings report to see how the stock trades. But yeah, certainly not. Certainly not. I wouldn't do a covered call on it just because it missed earnings. I'd need to look into that a little bit more. Lena says, when we issue trades, will we mention dates of earnings so you can stay out? We do mention earnings in a number of cases. Most of the IK trades have an earnings date in there. The earnings date is also available on the website. If you want to look it up, you can look on the trade idea generator page and see it there. We mention it sometimes if it's relevant in portfolio trades. Typically in portfolio trades, we're trying to avoid earnings anyway. So that's sort of implied there. We do, this time of year especially, or this time of the quarter especially, a lot of earnings aren't really, some of the late cycle guys aren't really scheduled yet. So it can be a little bit hard to pick some. I know we have, I forget exactly which trade it is, but there is a diagonal spread that's out there now that is not, I think it's EXAS maybe. The company finalized their earnings date after we put the trade out, and it ended up being a little bit before. So yeah, we're going to try to close that up early, and we'll see what we need to do when we get closer to that. It's still like a month away, so I'm not super urgent about getting out of it yet, but we do take that into account. So Rick says, what factors are used to determine if one or two contracts are to be traded? I'm not sure exactly what that's a reference to, Rick. My guess is it's in portfolio trades. Sometimes we put a 1 or a 2 next to things, and that's really about sort of trying to keep the dollar figures sort of in line. So, in the vertical spreads, typically if it's a $5 spread, which is about the widest we'll do. So $4 or $5 we'll typically do one contract, and $2.50 or $2 or $1 spreads we'll do occasionally. We'll do two contracts. That's obviously not exact, right? Like two contracts of a $1 spread is certainly not the same number of dollars as one contract of a $5 spread. But yeah, you can certainly do that in be more precise with that if you're so inclined. But that's what we're trying to do there, and that shows up occasionally in the diagonal spreads too. But we have a much wider range there in terms of the potential number of dollars at risk. And so yeah, I mean, ideally, if you're trading, you'd be putting similar amounts of money into every trade, which is can be difficult, but if I, a $40 diagonal spread versus a $20 diagonal spread doesn't necessarily mean I like the $40 spread twice as much. Even though I'm putting twice as much into it, it might probably just means that's how the sort of the numbers work, is you have to do a wider spread on some stocks. And so that sort of one or two contracts is really to try to sort of balance that out a little bit. Obviously, those sort of final decisions are entirely up to you. But yeah, that's really what's going on there, is just just trying to kind of keep position sizes a little bit closer. All right, so Lena says, we mentioned the put-call ratio, and how often might the ratio of put buyers to put sellers? She has doubts on trying to guess based on open interest on puts. Yeah, trying to determine buying activity versus selling activity is tough. We have the unusual options activity, investors keyhole trade. That's, from the analyst perspective, that's a lot of times the hardest one to find because the data analysis is tough. And typically what we're looking for there is, right, so you can use open interest versus volume when you're looking for sort of to open versus to close, right? So if volume is higher than open interest, then somebody has to be doing, the transaction has to be to open, right? You can't close more options than exist. Where it gets tricky is on the sort of who started this thing, right? Because for every put buyer, there is necessarily a put seller. And so to tell sort of who initiated that transaction, you really have to look at the price in terms of what was the bid ask at the time, and then how was the transaction priced. And so something that's priced on the low end closer to the bid will typically be a seller initiated trade, and something that's on the high end closer to the ask will typically be buyer initiated. And so that's how you do that. But in terms of looking at the put call ratio, you really can't determine sort of who's buying and who's selling based on that kind of data. You really have to look at that on a transaction by transaction level, which is data intensive and or time consuming. All right, so Rick noticed that the morning update format this week has changed. That is a thing that I left out. Yeah, so we did change the format of the morning update a little bit this week. We sort of combined two newsletters that we've had. We've had the Market Intelligence Center, which at one point was an entirely separate website that we combined with the Investors Observer earlier this year. And then now we've just sort of gotten around to combining the two newsletters. And so, yeah, that stuff is it's still most of the pieces are there. There's just two newsletters wrapped into one now. So the morning update stuff is there. And then there's also some other articles from our Market Intelligence Center are all in, just all in one email now instead of two. And we did that largely for reasons of simplifying our lives, and also why would we send you two emails every morning when we could just put the same information in one email? And that is, sort of to get ready for some changes that we have coming that I alluded to earlier, but can't really say much more about because I don't know when it's going to happen. But thank you for noticing, Rick. All right, I'm not seeing any more questions coming in. Our next workshop will be, I think we may actually push the next one back into the first week of August for some personnel reasons around the Investors Observer office. Don't think July 31st is going to work. yeah, we'll send out invitations ahead of time, and it'll be, there'll be a link to sign up tomorrow with the correct date, along with a recording of this presentation and a copy of the slides that will be available for download on the website tomorrow, per usual. We'll send that out sometime tomorrow to everybody who is here listening. All right, so with that, thank you for coming. Feel free to send us questions. You can hit the help button on the website or give us a call. Pretty much anytime we're here from 8 to 5 Eastern, and we're more than happy to answer questions. So yeah, thank you for coming, and I will talk to you again in several weeks.